we have Dhananjay also who's joined us now. Dhananjay, your view on this entire space, because one side we're seeing, as to how crude prices could overall see an impact in the first half as well, although they've taken price hikes, so volumes might be protected. But amongst the paint players, right, any particular one that you're liking? And as to, your commentary on how Birla Opus has scaled so quickly and now almost is ready to take over as being the second largest player in the paint space.
So I think for the broader paint segment, I think the increase in raw material cost is a very important variable to look at this juncture. Companies have been able to are increasing prices in the anticipation of higher raw material cost. I think that is already happening. We think that cumulatively price hikes could be of the order of 15% or there are 14-15%. And I think what companies have done is roughly about 2-3% in April. Also, there has been some hikes that have been there. So I think there is definitely a raw material cost pressure that is imminent in the near term. So that is there, and I think the space has been fairly competitive with Birla Opus being there. There has been rejuggling in the overall market share. Asian Paint also was under a drag earlier on. So I think that's the broader context of the paint market. So near term, it does look to be somewhat on the weakish side. With respect to Grasim, I think it has been a phenomenal journey in terms of the increase in the market share. They have gained about 370 basis point year on year, and that's largely because of the distribution aggression that they have done, the products that they have actually introduced, etc. And I think the promotion activity has been there. So it seemed to have done well.
So Grasim setup, Dhananjay, seeming to be much better technically and fundamentally right now. Dhananjay, let me come to you on the banking front. From a technical perspective, everyone's of the opinion that the setup is looking very weak when you talk about banks, Bank Nifty as a whole. And especially it's the private banking space which has been on the back burner versus the PSUs. From the way valuations are panning out, the way Q4 numbers have panned out, getting into FY27 as a year, would you be a buyer? And if so, what would your top picks be?
So I think if you look at the fourth quarter, there were expectations that there will be a revival in earnings for the banking space, given the context that credit growth had actually picked up to almost like 15+% from about 11 odd percent. So the expectation was that this would translate into better earnings, NII growth, etc., and NIM spread as well. Whereas what you've seen is that it has been a fairly mixed performance. And I think the larger banks have actually seen fairly weak operating performance in terms of the NIMS growth and the NIMS margins as well. So I think there are reasons why various banks are telling why it has been weak. But I think from a forward-looking standpoint, we do expect that the liquidity scenario could tighten. The G-Sec yields have actually gone beyond 7, 10 or thereabout. So we are expecting that as inflation moves up, there can be rate hikes later this year. So the cost of fund for banks might actually increase going forward. At this juncture, it doesn't look like banks have the pricing power on the lending side. There hasn't been any major qualitative improvement as far as the lending growth is concerned. So my sense is that for the next 1 year, assuming that inflation goes up to 6-7% from a headline CPI standpoint, we do think that the banking sector might actually underperform. So that is where it is. I think the PSU banks have actually taken a major hit, SBI in particular. And I would say that it will be better to be with banks who can actually manage their ALMs, asset management liabilities better. So I think some of the large private banks can available at cheap valuation can do well.
Dhananjay, let me come to you. A quick question. A dividend yield play, in terms of the way bond yields are panning out, do you think that's the right way to look at it right now?
So I think as far as the dividend yield is concerned, it has to be companies that benefit from higher commodity prices. So, Coal India, I think somebody mentioned that's an excellent dividend yield play because you'll have higher energy costs, higher coal prices. that translating to better profit, and also it is also a PSU company which actually offers a fairly high dividend yield. So I think that one can look at some of the commodity plays who are stocks that can give better dividend yield. So I think going forward, past history is a track record to really look at. But I think going forward, since the earnings are going to be volatile in a context where the cost of raw material will decrease, we have to be fairly selective and look at sensitivity of rising costs with respect to top line. So I think material space is relatively better for dividend yield.